Hey everybody, and welcome back to H Invests. Today we're talking about put options and how you can use them to make money from market declines. We're going to be talking about my strategy and what kind of factors I look for in companies when I place my put options on those stocks. Okay, I wanted to start with a big disclaimer first and foremost. Put options, they're an incredibly risky investment strategy and I'm in no way endorsing the use of them in this video. It's purely educational. I'm going to talk you through what I'm going to be doing and please make sure you understand exactly how these derivatives work and the risks that you're taking when you use them. For example, here is a long put option payoff diagram and what you notice is obviously you pay a premium when you buy these put options, right? And if the price of the underlying stock is still above that strike price where you bought, you're going to lose 100% of that premium and 100% of your investment because that stock option is going to expire worthless. So that's what you've really got to understand, that put options are only for investors with very, very specific circumstances who fully understand the level of risk that they're taking, and even when you do use them, it's important to balance that level of risk in your overall portfolio. I hope you guys enjoyed the video. Right, so as I said, the key discussion in today's video is how to find these best kind of companies. Now, why would you want to do that? Put options have a number of key advantages of being useful in market declines. Number one, you've got a leverage position, which makes money on the market going down, but also it's without borrowing, right? It's not like you're doing a short. If you went short a stock and then the stock doubled in value, you've lost all of that money, right? But if you went short a stock and it tripled in value, you now have got extra that you borrowed that you don't have, that you have to pay back to whoever you borrowed the stock off. And put options don't have that. They have the leverage position because they are finite. It's not just a share in a business that you have forever until you want to sell it. They all have an expiry date, and that's what creates the leverage position. And also your downside is limited. So you are capped at the premium you've paid. So there's quite a good risk payoff there. If there's going to be a big market crash, the way this is set up is quite good because you've paid your money. That is your risk that is capped, but they're also leveraged. So if you see a big correction, you can create really substantial returns on these options. I'm going to show you an example of one one trade that I did in the last 6 months later on in the video. And you want to consider them. This is a very interesting diagram. So we've got the NASDAQ here, and we've got the 50-day moving average in red, and we've got the 200-day moving average in dark blue. And what you can see is for the vast majority of the time, NASDAQ above the 200-day moving average. As I'm sure a lot of you are aware, 50 and 200 are very, very key levels in the stock market. These are the moving averages that so many investors look at. And that kind of creates a self-fulfilling prophecy, is that they become even more key levels because so many investors look at them, right? And what you can see, NASDAQ is above the 50 and above the 200 when it's in a good bull market. If it's having a bit of a corrective period, it's sometimes below the 50, but it's very rare for it to be below the 200. And you can see this is in the last 5 years, right? The only times that it's been below the 200 was when we had that FANG correction in late 2018, starting in October, and that pulled down big tech stocks by really, really high percentages. And then we had it again when we were going to have that COVID bear market before the Fed injected us with a load of money. But you can see the NASDAQ is below the 200-day moving average there. And why is that important? It's important because now, for the first time in a long time, that NASDAQ is touching the 200-day moving average. In fact, yesterday, which was the 18th of January, the NASDAQ closed below it. So if the NASDAQ closed below it again today, we really could see negative momentum slides. And I'm not going to go into details of why I think the stock market's overvalued or anything, but I'm sure everyone watching this video has their own opinions on that for themselves. But you can very clearly see from this diagram here that we're not on the same luscious upward momentum that we were in 2020 or even the early parts of 2021. Okay, so what I look for in companies to place puts, there's a lot of different factors. We're going to go through them now. My target ultimately is to find overvalued companies where the price has risen on hype rather than fundamentals. And what this will cause is it will cause the companies to be trading on very, very thin ice when the market takes a nosedive, because people will know they've been buying for castle in the air, they've got no idea what the true value of this company will be. And then, yeah, when the market has a big correction, these stocks are usually the first to go, particularly if they've gone up an insane amount in the past couple of years and that positive momentum is not starting to be as concrete as it once was. So the first thing, market cap of more than 5 billion. The reason why I like this, it's not so much to do with the fundamentals of the business, but I just find that the liquidity on options is much, much better around this kind of level or above this kind of level. When you get below 5 billion, some companies, they're okay if they have very, very high option volume, but what you'll find is you will find some really, really high spreads between the bid and the offer, and you just don't want that. You know, you don't want to be paying 5% extra when the spreads can be much, much narrower. So that's basically why I'm looking for larger cap companies. High price to turnover, very, very important. So this is kind of the key value metric that I'm using here. Couple of reasons why I'm using turnover. Number one, a lot of these businesses are not profitable yet. That's the thing. And even if they are profitable, you know, their earnings per share or their free cash flow is kind of all over the place because the business is reinvesting in R&D, trying to grow itself as quickly as possible. And turnover, I think, for a lot of these companies is the only real core gauge you have of how well the business is really increasing operationally. And it's the best for comparing like for like, in my opinion. So that's what you want to consider. Most of these companies aren't profitable. The other thing about turnover is it's very, very difficult to manipulate on accounting standards. So turnover is turnover, right? With EPS, you've got diluted, GAAP, non-GAAP, you know, normalized, reported, all of these different metrics, which can confuse a lot of investors. But turnover is turnover. It's sales at the end of the day, and it's very, very easy to kind of track and compare one company's turnover to another. Okay, so price to turnover as more than average price to turnover. So what I'm looking at here is I'm looking at, is the company trading a much higher price to turnover multiples than it was in the past 3 to 5 years? Because this might be suggesting possible euphoria. It might not be suggesting possible euphoria if the company's growing faster and faster, but it might if the company's growth is slowing down at the same time as higher multiples. And believe me, it does happen, because the fourth factor we've got is the forecasted turnover growth being slower than the past turnover growth, right? So is that turnover growth slowing down? And when you get these two in conjunction together, that is the definition of something that could be overvalued. So those two are always very important. Another thing that I put on these kind of filters is how much has the stock price changed since pre-pandemic, right? How much of the Fed's money, how much retail speculation has gone into this stock? How hot is it? So that's a very important factor to consider. And also, what shape is the business in? You know, how do the future prospects look for the company? A lot of these businesses that you're going to be looking at that come up on these filters, they are going to be quite good businesses, but are they as good as what the market is pricing in? You know, like Tesla, for example, you could say Tesla is a fantastic business. You're not shorting Tesla because it's a rubbish business, but is it overpriced? Those are the kind of things you want to be thinking about. Okay, so I'm going to show you one of my bearish filters that I set up on a software that I use called SharePad. It cost me about £300 a year. And here is the filter. So let's have a look. Here's the market cap of 5,000 that I mentioned. So I'm not looking at any companies below that just because I want, you know, liquid options with tight spreads. Price to turnover, so I put in a minimum of 15, which is pretty high. Most of these companies, you know, when you combine it with the other factors, they're way, way above 15, but I like to use that as a minimum. Okay, so this next one is price to turnover as a percentage of price to turnover growth, 3-year average. So what we're actually looking at, sorry, not turnover growth, just turnover. What we're looking at is we're looking at what percentage of the price to turnover ratio now is it compared to before. So obviously you want it to be a higher. So I've put a minimum of 130 here, which gives us a good margin of safety that the price to turnover is much higher than what the average of it has been in the past 3 years. And I use 3 years because, again, a lot of these companies are quite young. And that's interesting, is that when they're younger companies, they often have even higher price to turnover ratios. So if they're having a much higher price to turnover ratio as they're maturing, that is often a very, very good sign. But then on the flip side, what we want to be looking at is we want to be looking at companies which are growing slower in turnover going forward. So what I've put here is, forecasted turnover as a percentage of the past annualized turnover growth, both over 3 years. And I've capped that at 100. So what that's saying is that the analysts, the average of all the analysts, are forecasting slower turnover growth going forward. But this company's got higher multiples in the past, right? So how does that make sense? You've really got to try and find these kind of companies that the market has still got all of that future expectation baked into it, but really analysts are cutting their turnover growth, the turnover's growing slower, the price of turnover is still going up, and there you have your undervaluation opportunity. Above 50% share price change since 31st of Jan 2020, which was just before the market started to have this major correction. Again, most of these companies are way before, and they're actually sorted by how much the share price has increased. And that's it. And also there's a couple of other factors on here that I'm looking at just to give me a bit of a hint with regards to how quickly the turnover is growing, the beta, so how volatile the company is relative to the index, and also, looking at, it's just the net profit is giving me an idea of whether the company is profitable yet. So if they do have a good level of profit, I'm just trying to work out if using a PE or using a price to free cash flow is actually going to be realistic here. But I'm not actually filtering by it because, as I said, most of these companies aren't making profit, and you can see actually about half of them that have come up on the filter, they've got a minus sign in front of them. So yeah, that's basically showing that they're not profitable companies yet. A couple of other things, I've already mentioned these, but technical analysis. So the ideal momentum pattern that I'm looking at, because it is very important to look at not so much very deep technicals. I'm not a technical analysis expert, but you want to be looking at the general pattern of the share price. And my ideal pattern for this would be, steady increases throughout 2018 and 2019. Then after the COVID correction in 2020, once the Fed has pumped that liquidity, huge share price increases, incredibly high positive momentum throughout 2020. Early 2021, still some positive momentum, and then Q3 2021. This is as of today, by the way. That positive momentum starting to slow down, and if we can see a bit of a correction, recently, which is probably likely because year to date 2022, as I speak, the NASDAQ really hasn't done very well. That would be good. So you want it to be near all-time highs, having had a big acceleration but slower share price appreciation, and then a bit of a correction. You want to see it just at that tipping point where people, there's not the same enthusiasm for the stock as in the past, and people are maybe starting to question whether this is actually a fair price to have the shares at, or whether they're trying to sell out, and they can't find the buyers to meet it because it's crazy prices. Prospects of the business, as I said before, most of these prospects for the business, they will be good because they're growing their turnover very quickly. You can see here the forecasted turnover growth. Here the forecasted turnover growth. So most of them are in double digits, annualized positive turnover growth. So they are good businesses. But again, is the market overestimating it? If you've got a business that's at hype on 100, right? It only has to get to hype 90 before negative momentum starts to compound. It only has to have the next biggest hype that comes in and grabs shareholders' attention, and shareholders will be selling out and they'll be moving to the next hype. So that's what you've got to remember, is that when a business is at the peak of its hype and the peak of wow, it's fantastic, it can't get any higher on that level. It's only a down there, less enthusiasm, and thus that puts negative momentum on the share price. Short interest is always a good one. I can't filter by short interest on here, but it's looking at, all of these hedge funds, how many of them are shorting it compared to the total market cap of the stock. What's that level of short interest? Because that's really going to help the negative momentum. And also the level of retail hype, I touched on that a minute ago. Okay, so I'm going to give you an example trade, which I've already closed, which was using this put option strategy, and this is on Roku. Now Roku were basically a hybrid hardware software streaming service that's predominantly US based, and they provide this kind of box that you plug into your TV, and it gives you all of your TV streaming services, YouTube, some of Roku's own streaming content, all on there. So it's kind of like a Netflix, but with this hard box as well. They make much, they're much smaller in terms of content than someone like Netflix. A big part of their business is selling this hardware. But back in July 2021, and bear in mind, like, I would love to show you the filter in July 2021, you know, and show how crazy some of these stats for Roku were. Obviously, I can't show that now because Roku's not showing up because the share price has declined by so much. But let me go through exactly what I was thinking at the time. So the share price was up 3x from pre-COVID highs. So you can see that here, we're trading at about 150 pre-COVID highs here. And then we had 2 bits where it briefly touched above 450, so 3x. It passed all the filters, which I've mentioned. Huge level of retail investor interest. The amount of articles being published on Seeking Alpha, the amount I was seeing on places like eToro about Roku throughout 2020 and 2021 was absolutely insane. But little to no economic moat. I'm going to talk a bit more about the business on the next slide, but that was something that I picked up on. I thought, okay, maybe this competitive advantage of Roku isn't nearly as high as what the market think. And also avoidance and short interest from the most respected investors. So Roku had quite high short interest when I placed this trade. I believe it was about 8 or 9%, which is incredibly high, particularly for a company of this market cap, right? And also a lot of legacy investors were avoiding Roku completely. It was a big position in Cathie Wood's ARK fund, which actually only helped fuel the retail hype, because that ETF is very, very popular among new retail investors looking to get these futuristic tech, fast-growing, highly speculative stocks. Okay, so what I can show is I can show a graph of price to turnover provided for me by the wonderful Ticker Terminal, and you can see the normal range of Roku's price to turnover is about 5 to 10x its turnover, right? But you know, when we got into 2021, we had huge share price appreciation. The turnover just wasn't keeping up quick enough, and we went into this range of 15 to 20x, and it even got above 25x at one point. I was actually buying the put options in July, as I said, so I was buying it just above the 20x level. But you can see the turnover change here is that, you know, it'd been growing faster and faster in terms of turnover, but that had been stagnant, right? And Roku had huge tailwinds from the lockdown. And I was thinking, right, okay, there's something going on here. And basically, when I looked into the business, because I'd never heard of Roku. Like, if you're an American watching this, you'd probably be like, geez, are you crazy? But no, I live in the UK. I'd never heard of Roku before I saw it as an investment. No one in the UK has heard of Roku, basically. And the problem is that Roku had saturated the US market throughout lockdown. They're in something crazy. I can't remember exactly how many homes, but it's a significant proportion of, you know, the total homes of the United States. But they were very much struggling to get into the market share outside of the US. Because there's so many other companies competing in it. You know, Sony are competing in it, Apple and Amazon are very big in the UK, and look at the amount of monetary resources they have to throw at this, you know, the amount of teams and all this stuff that they can work on to clear Roku out the market. Even a lot of smart TVs, you've got this kind of like, you know, Netflix, YouTube thing all inbuilt into it. So I just didn't see the economic moat from Roku. Is it a good business? Of course, I've got to say it's a good business if it's been growing its turnover at this level for 5 years, right? But is it this insane business that the market was pricing in? And has it got like a durable competitive advantage? Is it going to be here in 20 years? I just didn't see it, right? For those reasons I aforementioned, I just didn't see it being able to establish a foothold outside of the US market when it's got all of this competition. And also the fact that it's saturated the US market is going to make it more and more difficult. And this is what the analysts were thinking too. You can see its forecasted turnover growth here was much lower, right? But by 2023, it was almost half of what it grew in the lockdown. So the price of turnover was at all-time highs. I was seeing this, and I went on and I put a put option on the shares. And now we're going to go through exactly what that trade looked like. So here is the trade. I wanted to be completely transparent, so I've screenshotted everything. I bought my put in Roku on the 23rd of July of last year. And you know, again, so with regards to exactly where I bought it, a big part of it was luck that I managed to buy it literally right at the top when the shares are trading at 473. Part of the decision was that, okay, like there was this resistance here and it wasn't really breaking through so well, you know, it got up to it here. So part of that was just really, really good timing that wasn't fully down to me finding the, perfect price to execute. But this is why I've got a long-term option. You notice the expiry date on this, September 2022. I bought this in July 2021. So the whole idea is, okay, you pay much more for a long-term option, but then it doesn't matter if the shares don't crash overnight, because you hold it for the long term. As long as you've got conviction it was going to have some big correction in the next 12 months, which I did, then it doesn't matter so much. And then I sold it in December. So let's have a look at the numbers. I sold for 22.5 grand. I bought for 10.4 grand. So the profit was 12.1 grand, which is a 116% return on what I bought it for. And the shares were down from 473 to 221 at this time. So 53% drop. So you can see that my option was roughly 2x leveraged, or minus 2x leveraged on the share price of Roku. But this is the big caveat here, is you've got to remember, I risked 10,400 on this trade, right? So this is the thing about options, and it's kind of hard with Roku because each option controls 100 shares, right? So when you're buying 100 shares with a high share price, what I'm saying is Roku shares are 460. And when you're automatically controlling 100 shares, that then turns into 46,000, right? So this is where the issue comes with shares that have very, very high prices, in the sense that if the share was $100, you'd only be controlling $10,000 worth of shares, and these premiums would have been much cheaper. And I risked $10,400 to make that 12.1 grand. And if Roku was trading above 460, which was the strikes, so I bought it pretty much at the money. If it was trading above 460 on this date, the 16th of September 2022, I would have lost 100% of my money. That is the key difference here, is that, when you buy stocks and you buy shares in a business, even if the business doesn't do so well, it still has some assets, it can sell off, it's hopefully still making some level of money. This has got no underlying, core underlying value. It's not like you buy a REIT and you're buying a couple of bricks in the building. This is literally a derivative contract that's very finite in time, and for that to expire in a year is a big, big risk. And then in order for me to profit, so obviously it cost me 10 grand, right? I'm controlling 100 shares. I bought at 460, so Roku would have to be trading below 360 by this date, by the 16th of September, for me to make a profit. So I sold out here. Maybe I sold out a little bit early because the share prices continued to go down. But as I said, when I was rerunning these filters, I was looking at Roku in December and thinking, it's not the crazy share price it once was. I was obviously up 116%, and I was still seeing much better opportunities from the filters. So I sold off, and now I've rolled that money into other long put option positions. I'm going to go through much more about all of the technicalities about buying options, what strikes to go for, what durations to go for in the next video. So in summary, please make sure you fully comprehend the risks of trading options. Please, please, please do. That's not my responsibility. Please get educated, and this is not for everybody. Please understand the different risk profile that I've just outlined and how it's different to buying underlying stocks. In summary of my strategy is buying put options on companies with higher price to turnover ratios than usual, with slower growth forecasted going forward, whose share prices have risen drastically from the pre-pandemic levels. And as I said, the next video, I'm going to be covering many more specifics, such as what strikes, in the money, at the money, out of the money, what expiry dates I like to choose, and how I kind of manage my positions and manage the option portfolio going forward. Please let me know in the comments anything else you'd like me to include. I'm going to be making that in the very near future. I hope you guys found this video useful, and good luck with your investing. All the very best.